Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 7th of June. I'm Daniel Lam, your host for the podcast. One of my colleagues thought that Gordon Gekko said, "Why earn trillions when you can earn billions?" Well, for those of you who watch many movies, you must know that Dr. Evil from Austin Powers said that line. It would be very difficult to imagine Gordon Gekko saying that kind of line, being infamous for his greed is good mantra. Now, some investors who've been making profit in this Nasdaq 100 rally may be contemplating if they should be getting quote-unquote greedy and add further to US technology sector. They must be assessing what factors may pop this bubble. After the debt ceiling saga, the obvious factor would be the US government filling its Treasury General Account, or TGA. That means the issuance of US Treasury fixed income papers in order to finance for the US government, and that may potentially suck liquidity out of the system. Our assessment is that, yes, there's risk of pullbacks, but it is unlikely to lead to a sharp fall in US equities because, actually, there's not so much frothy equity inflows out there. So first of all, much of the liquidity tightening may have already been priced into the markets. Now, if you look at bank lending growth, it is slowing in line with a late cycle economy, but it's not slowing at an alarming speed. Actually, in general, this is a feature in US data, i.e. they have been slowing, but they're slowing at a measured and non-panicking way, which is getting reflected in the relatively low volatility in US equities. Secondly, in previous episodes of TGA refilling, positioning in US equities were low, very similar to the current positioning, and they actually rose during the refilling, i.e. investors using the supposedly liquidity draining event to add to US equities. Thirdly, a large part in US technology stock really was due to short squeeze and long short hedge funds buying via out-the-money calls. This was because short interest in technology names picked up significantly in the month of April and in the earlier part of May. Now lastly, and that to me is a bit of a surprise, retail investors have only been buying technology stocks very modestly, certainly far from the scale that we saw them buying back in the first quarter of 2021. So investors may consider slowly locking in some profit and rotating into other regions, such as Asia ex-Japan and Japanese equities, but they do not necessarily have to get out of the US technology stocks en masse, because the technical factors that we showed above are still supportive. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.